Hi, everyone, and welcome to this episode of Money Moves. We'll start off by talking about why everyone thinks a recession is coming in 2023. Then we'll go over all of my investments in my portfolio, and then we'll go over my results for the month. If you like investing and making money, definitely like and subscribe. I make videos like this every single month just to keep track of my portfolio growth over the years. And make sure you hit the bell so you don't miss out on any future episodes. Welcome to the Portfolio Bulletin. Let's get started. So why does everybody think that there's a recession coming in 2023? Of course, we have the Fed raising interest rates, putting a strain on the economy overall. The question now is, are corporate earnings going to start going down? Because we haven't really seen that happen quite yet. They also mention here it's quite unusual. They say usually recession sneaks up on us, and CEOs never talk about recessions. And now it seems like every CEO is falling over themselves, saying that we're moving into a recession. Even every economist is saying that we're going into a recession, and that it seems quite unusual. They say historically, when you have high inflation, the Fed just jacks up interest rates to reduce inflation, which generally results in a downturn or a recession. Of course, that's what we're seeing right now, and that's what everyone is concerned about. They go into more detail saying that the Fed is causing this downturn and that we've moved interest rates up significantly up to a range of 4.25 to 4.5 in just a couple of months, which is extremely fast. And the Fed is still messaging that we're going to go higher up to about 5.1% next year, starting with the FOMC in February. We're starting to see the effects of that with home sales down 35.4% in November, which is a decline for the 10th month in a row. And then we're seeing interest rates continuing to rise on mortgages up to close to 7%, with inflation still at 7.1%. All of these things are very concerning for the economy, and all of these factors together certainly seem like enough information to think we're going to go into a recession. They mention we're starting to see transmission of these mechanisms through the economy. Companies are starting to cut their headcounts. They're starting to reduce their costs, and all of that economic growth reduction should start to bring down inflation as well. But this is the big question, right? How bad is it going to be? Of course, nobody really knows the answer to that. It could be quite bad, or it could be quite tame. It depends on how the economy reacts to the high interest rates being produced by the Fed. The most recent information from the Fed says that they plan to see economic growth of 0.5% in 2023, which is technically not a recession. Any kind of growth is still not a recession. You have to see negative GDP for it to be a technical recession, which is why people talked about it being a technical recession for Q1 and Q2 of this year. Then we saw growth resume later this year and actually got moved higher on their revisions. And then this is the big talking point going into the end of 23, possibly the beginning of 24. Are we going to see that Fed reversal? Is the Fed going to start cutting rates by the end of 23? They say by their own forecast, they're planning to cut in 2024, so we shouldn't plan to see anything before then. The Fed seems to be very concerned with inflation, to the point where they are willing to see the economy move down as a result of their actions in order to fight inflation. So they've been quite stalwart on that. And I don't think it's likely that they're going to change their minds if we don't see a very significant recession. They then go on to talk about jobs. They say at the beginning of the year, we were getting about 600,000 new jobs each month. Now we're getting about 250,000. And there are certainly some people saying that these are slightly inflated numbers, and they plan to see it go down to around 100,000 by next year, and should go down to 0 or maybe even negative in next year at some point. By the Fed's own words, they plan to see unemployment go up to about 4.5% from 3.7%, so that is normal for an economic downturn. But like I said before, I think the big question mark is corporate earnings. They don't really mention it very much in this article, and they definitely should. Going into Q1 earnings in February, basically the last week of January through February, that's really going to tell all on where we're at with this recession. Of course, CPI and inflation numbers will be a factor, but the big question for me is corporate earnings. And if they are stronger than expected, we could see a pretty decent up move in the markets. I think a lot of people are factoring in the idea that corporate earnings are going to go down. And if they surprise to the upside, that could be very strong for the markets. Moving over to my investments, starting with Worthy Bonds, I continue to hold this investment, and I have no issues here. I also had one referral, so you can see I do own a little bit of Worthy property now, but I continue to hold this about $5,200 here in Worthy Capital. I know they had some liquidity issues, and I did talk to them a couple times about that. Definitely check out my other videos on Worthy Capital and the comments on those videos to see a little bit more details there. But I haven't had any issues with Worthy, and they do seem to be doing the right things. And you can actually buy bonds now in Worthy property. All the Worthy Pure Capital and Worthy Community are sold out, but Worthy Property, from my understanding, does still have bonds available. Moving over to Groundfloor, you can see I have a little bit over $10,000 invested with them. I continue to reinvest all of my earnings here. So I made about $720 here this year. Expected earnings on future investments, almost $1,000. I plan to reinvest every single time I get paybacks, and I don't plan to take any money out quite yet. And you can see my holdings here. I actually started investing in some B notes here recently because they are now offering some 10% loans on B notes. So a little bit less risk, but still getting 10% returns is nice. The D notes are now in the 13s, and the C notes are usually 11 to 11.5%. So I did start to get a little bit of B notes just to balance out this ratio. You can see I'm very highly invested in C notes. That's the vast majority here because I was trying to get those a little bit higher rates, but not too much risk. But otherwise, that's my strategy right now. Mostly C notes, a little bit of B right now, and sometimes D when they're available. And as long as the average renovated value is decent. I do want to show you what I mean here. So on their platform, they do have valuation, and these are loans that are currently available. You can go by note. B notes here, usually 9 to 10%. You can see some C notes. But as long as this average renovated value is very low, these are extremely low, right around 50%. They expect this to grow by 100% of the note value when it's complete. Those seem to have less risk in my opinion. And then you can go down here quite a ways, get into the 60s and 70s. And once you get really above 70, I don't really invest in these. You can see here, I don't have any of these notes. But you can get all the way up to 14% if you do want to take a little bit higher risk, right at 75% average renovated value is the size of the loan that they took out. So they took out $270,000, and they expect this to be worth about 25% more than this loan value when it's completed. Otherwise, I pretty much stay just below 70 and try to get this 10, 11, 11.5% returns on this money. And you can even see here my investments in these higher renovated values is a little bit lower. So $20. And then as you get a little bit lower here, $30, and then I'll start to invest $40 once I think we're a little bit more safe on that. And sometimes I do $50 when we're in this lower value as well. Moving over to Fundrise, they put in their year-end appreciation. And you can see here, I actually took a loss on appreciation this year, which is not surprising. Real estate has definitely been falling. And I did kind of expect this. You can see dividends were still quite good, $1,700 this year. Not terrible, even in an account that is more focused on appreciation and not dividends. But it's worth noting here, you can see minus $550 on appreciation this year. And you can see here exactly what that means. So I was up at about $64,660. And then right at the end of the year, down to $63,057. So a little bit of a downtick. And you can see exactly what that looks like here. So the Q4, which is almost complete, you can see most of those losses here on the flagship real estate fund, 7.4%. This is a pretty big holding for me. So that's most of the losses there. Growth REIT, 7, also down 8.1%. So the two biggest losers here in the previous quarter here on Growth REIT 7 was also pretty rough. So if you look at this in dollars, you can see $1,141 here on the flagship real estate fund, which puts me net year to date $671 in the hole on that fund, and only $68 here on this one just because there's so few dollars in this REIT at all. And then year to date after that, we had $29 in the hole and then almost $17 in the hole. Everything else that even if they took losses in the last 2 quarters was still positive on the year. So really Q4 hurt it a little bit, and the flagship real estate fund being an issue here. It might be worth investing in a little bit more of the income-based fund here recently. I own very little of that, and I might try to buy some more of it a little bit more specifically going forward, but otherwise not bad returns on the year. Moving over to my TSP, which is my retirement account. This is a Roth IRA for the most part, and you can see my holdings here just over 81,000. Majority of that is in stocks. When they say cash, they mean government bonds here, and then corporate bonds at 4%. You can see what that looks like in dollars, a little bit over 5,000 cash. Bonds down a little bit. C Fund down quite a bit this month. This is the S&P 500, which obviously struggled here in December. And then this is the S Fund, which is the total stock market fund, also down quite a bit here in December. Not too bad, but definitely lower. I think I lost about $4,000 even with the money that I put in this month. And I still plan to hold this for 30 years plus, just based on my retirement age. Moving over to my M1 Finance higher yield savings account, you can see we lost a little bit over 3% returns on the month, made a little bit over $100 in dividends, so very strong dividend month, but the market gains were minus $785. This account was almost at $20,000, and you can see now we're below $19,000. Got a little bit of cash here, so I might try to buy some stock. But if you watch my market reviews, I think we're going to go up here for a little bit and then go down later in January, so we'll see how that plays out. Looking at the month, though, not very good. Real estate down almost 3%. Dividend appreciation down almost 4%, big loser there. Vanguard growth down more than 7.5%. This is basically the NASDAQ, which obviously struggled quite a bit. And then you have individual stocks down over 9%. Obviously, this is a very small holding compared to the account. Only $600, and it's only 3% of this account, so not terrible, but minus 9% is rough. International actually doing well, was positive on the month, up over 1%. So interestingly enough, International Dividend Select, IDV, decent, not bad. And then bonds doing exactly what you would expect, down slightly, 0.7% here, and then 0.8% on bank balance sheet. Finishing up with my trading accounts here, you can see just over 97,000, 97, almost 500 here. And that was actually up on the month. One of my few investments that was actually up a little bit over $2,000 this month. If you want to know more about this account, definitely check out my daily videos on market analysis and positions going into each day. Moving over to my monthly tracker, you can see here, very proud of this. We see trading accounts moving higher and stocks moving lower. So I was short the markets most of the month, and the markets went down throughout the month, so I made a little bit of money while the market value of stocks went down. You can see for a while here, I was generally trading on par with the markets, but finally I had my first month of really good market outperformance, and hopefully we can keep that trend going. Overall, though, not a great month. I actually went down 1%. And you can see my monthly invested totals here, 275,000 versus 278 last year, which was actually my all-time high. You can see I marked that here. 3 December was my all-time high. And everything went down pretty much besides bonds. Bonds went up here slightly. Like I mentioned, real estate went down because of the Fundrise reductions in asset prices. And then here, trading accounts up 3.5%, but some of that is added money. About 1% of that is added money, and about 2.5% was market gains. Let me know down in the comment section what you think of my portfolio and where you think the markets and the economy are going to go next year. Definitely like and subscribe if you got any value out of this video, and make sure you hit the bell so you don't miss out on any future episodes. Of course, none of this is financial advice. This is all for entertainment purposes. Good luck in your trading and have a great day. Good luck in your investing and have a great day.